A very good evening, everyone. Thank you so much for joining us today. My name is Mahima Lal, and I'm the part of engagement marketing team at Wired, and I'll be your host for today. So, everyone, before we move on to the topic or with the webinar, a quick introduction to this platform, which is Wired. So, everyone, Wired is a premium LearnTech company, which is the part of the larger Hero Group, which is on a mission to not only reimagine the way people learn, but also build a better and a brighter future for themselves. We at Wide ensure that we are equipping our learners with the right skill set, the right knowledge, and the expertise that they require in order to find success. So as you all can see that today we are presenting a webinar on the topic from success to bankruptcy using predictive analysis and equity research. And in order to present this topic, we have Sambhav Golechha with us. A very warm welcome, Sambhav. So some of you might have already interacted with Sambhav in our previous webinars, but for those of you who are new to this webinar and new to our speaker Sambhav, a quick introduction. So Sambhav has 6 years of experience in equity research and corporate merger and acquisition. And he has also worked previously with Goldman Sachs, and he has also worked in consulting roles. He has been a faculty for financial modeling and valuation for NSE Academy, certified and NSDC approved courses. A very warm welcome, Sambhav.
Hi, thank you so much. Welcome to everyone. Very nice to see.
With Sambhav, we have Prateek Sharma with us. A very warm welcome, Prateek. So a quick introduction to Prateek. He is, has worked in the finance industry for past 10 years, and he has also worked in consultancy roles in companies like EY and Deloitte. And currently, Prateek is working as a subject matter expert for the programs into finance that are offered by Wire. A very warm welcome, Prateek.
Thanks, Mahima, and welcome.
So everyone, as you know that we are in a webinar setup and a quick hygiene check here. So if in case you would want to interact with Sambhav while he's talking about the topic and he's covering the topic, you have a chat box to interact with him. And in case you have questions related to what we're presenting today, you have a Q&A section open where you can put down your queries and questions. And we have Prateek and Sambhav right here to help you out with all your queries. I believe, Sambhav, we have a good audience and we can start now. Over to you.
All right, great. Good evening to everyone. Today, I think it's going to be a very interesting topic. It's basically a case study on one of the most successful companies. I deliberately chose a company in the US, so none of us probably know a lot about it. So we can look at it from a very unbiased perspective, right? The idea is to see how, as an equity research analyst, what we can do to forecast or predict when a company can go up or go down, or what are the tools that we need to use to do our analysis, right? So that will be the focus of today's webinar. Now, I would love some inputs from all of you guys, just to give you some background information, right? So the company that we're talking about will be a retail company, which means it has stores where you can buy stuff, right? So any ideas on what are the key metrics that we would want to look at to track a company and see if it is doing well or not doing well and so on? I will look for your answers on the chat box. Sales from Shweta, retail sales, okay. Per store revenue, very interesting. Ratios, profits, footfall, equity to debt, audited balance sheet, leverage ratio, EPS, great. I think we have some very, very good answers. So let's look at some of these one by one, just to get a flavor, right, of the analysis that we do. So a lot of people said sales, right? So if I just look at the number of sales, right, just the revenue numbers going up and up and up, does that necessarily mean that my company is doing well? Or if the sales are going down, does that necessarily mean that my company is not doing so well? No. Okay. So everybody agrees, right? And some ideas around that could be, okay, sales are going up, but all of those sales are maybe just marketing driven, right? So does not work. Maybe sometimes there are some black swan events because of which our sales could go down. And then as the event goes away, sales come back up. So then let's look at some other metrics that people mention, right? Per store revenue. I think this is a very, very interesting and insightful metric to look at. So per store revenue, any ideas on what drives my per store revenue? Location. Oh, everybody said location. Okay. Lots of people said location. Okay. Per store revenue. Fine. I would like to come back to this because I think of revenue in a very specific framework that I will share with you guys eventually. But let's come back to this whole point, right? Okay. Footfall, very, very important metric. I'll come back to balance sheet. A lot of you guys are mentioning a lot of line items or metrics on the balance sheet, but on the footfall, right? Footfall could be both positive or negative again, because people coming to the store not buying anything is a problem for me, because that still means I need to keep running the store. I need to have a lot of people in the store to attend to those guests, but nobody is buying from me, right? So just looking at footfall is also not great. So for people who have recently joined, we are talking about what are the metrics that we should look at to judge or evaluate a retail company, a company that has stores where you can go and buy stuff, right? So customer service is important. Someone mentioned, I think Shweta mentioned share price going down. Now, I think Shweta, as an equity research analyst, that is exactly what we are trying to solve for, as in we want to predict the share price movement. So share price going down could be good for us. For example, whenever the price of gold goes down, I get very happy and I want to buy more gold because I know gold has a higher value than what it is today. So just the prices going up or down does not necessarily mean that the company is doing well or not well. Looking at some other aspects, I think some people mentioned debt. Very, very interesting and important metric in a retail company, especially because retail companies, as we all know, require a lot of capital expenditure, which means you need to put in a lot of stores in place. You need to buy the land, you need to, or lease the land. You need to put in the building, which is usually your own expense. Then you need to put in the storefront, the racks to put stuff up, the cash registers, and it's there's also an inventory that you need to maintain. So a lot of capital expenditure, and whenever there's high capital expenditure, obviously there's a lot of debt that keeps piling up on the balance sheet that we always need to be careful about, right? What else? I saw some people mention bills generated per year. That is a very interesting metric, but again, not foolproof, because what if earlier I was selling as a retail company, I have a retail company that sells everything from pens to cars. Number of bills that I'm generating, what if people stop buying cars and only buy pens from me? The number will go up, volume will go up, but the value not going up. Return on capital employed. Okay, fine. We are going to more and more interesting metrics. Same store sales growth that Pooja mentioned is a very, very interesting metric that we'll get to, right? So wrapping up this little piece of conversation that we were having so far, the point that I was trying to make is you can never predict what will happen from one metric or two metrics or five metrics, right? The thing is, it is a comprehensive concert of multiple instruments that you need to look at, or it's a team of players that you need to judge. Kabhi only Sachin Tendulkar cannot win the match. You need all 11 players to work together, right? Similarly, one metric can sometimes look very weird, but maybe that's just the company changing strategies and so on. I can give you some very interesting examples on that. A lot of hotel companies have actually, there was a time some years back, maybe a decade or so back, when all the hotel companies started changing their strategy from an asset heavy strategy to an asset light strategy. What did that mean? That means that they started selling the land and the hotels that they owned and then keeping them on lease, or just keeping their hotels on a franchise model. So you will suddenly see a lot of negative capex or rather sales of assets. So sales of asset could be good or bad, which we'll see eventually, right? That's what McDonald's does, right? Exactly. So I will now reveal the company, so to say, and we shall start looking at the company. I think it's a very, very interesting case study. Let's move to the case study. Meanwhile, I'll keep the chat open so that, yep. Please let me know if you can see my screen.
Yes, Sambhav, we can see your screen.
Great, perfect. So the company is Sears, and at one point it was the biggest retail company in the US. They were an extremely, extremely innovative company, and they brought out a lot of very new concepts, new ideas in how retail was done, and a lot of things that they started with continues to happen today, right? So to give you a brief background about the company, right? So the company was started in the late 1880s, where the owner, which was Sears, started with selling jewelry and watches. Soon after, he came up with a mail order business, and Sears was originally a mail order business. What is a mail order business? It means that you place an order on call and then you get a delivery of an item. So very, very similar to your Amazon of today, right? Why was that innovative? Because nobody did that at scale at that point. Secondly, what Sears actually found, or what he innovated on, was the growth in the railway system in the US at that point. So he used an infrastructure development in the country, so more of a macroeconomic factor in the country, to grow his business. And he realized, because of railways coming in, now I can ship goods across the country at really low costs. So imagine, right, in the 1800s, you live in a small city, you want to buy something which is maybe manufactured across the country, you really can't get it, or you can get it like in once a year in seasons, right? When people really travel all the way across the country. In back then we didn't even have cars, right? So really people making that using carts and animals and so on. So you don't have easy access to all of these materials. So that is why the mail order business, using the railway infrastructure of the country, became a big, big hit. And really, there was a whole generation of Americans who grew up with the catalog of Sears in their houses, right? So you would receive these extensive catalogs on which you could place orders, and then you could receive your order in a few weeks, right? Days or weeks, whatever it was. Now, the interesting thing is that they started with like watches and jewelry, but they really started adding a lot of products, and then they were selling everything under the sun, right? From, as they say, from cradle to grave, you could buy anything and everything. So that was the very interesting bit. In the early 1900s, so around 1920, they did another invention, or rather an innovative thing that no major retail company was doing, which is they opened, and this is sound real silly now when I say it because we're so used to it, but they were the first big company to open a retail store. So what they did was, at that point is when the cars were starting to be manufactured. And as the cars were getting manufactured, they realized that the plazas outside the city will become important points of commerce. And they started buying a lot of land in those points. And as the cities grew, they started opening Sears stores right there, right? So then that was innovation number 2 in a long series of innovations, by the way, which we'll come to. So first they use the railways, then they use the cars and the highway network of the country, right? So the point I'm making is very, very innovative company, growing rapidly and selling everything under the sun from cradle to grave. Let me go to the next slide, right? So here's a full timeline. Okay, so people know a little bit about the company. I think really interesting conversation, great. So after that, 1920s, right? The catalog business started not doing so well. So they stopped that business. And meanwhile, they were basically a company that was involved in everything, right? So they had multiple companies that they started under their own umbrella and then started hiving off those businesses. So that includes like financial services, and I will eventually show a list of all the businesses that they started and then sold, right? So this is where you see them sort of getting distracted by a lot of different business models, maybe trying to turn into a conglomerate, but not really working, right? In the 1900s, they also had another very interesting or innovative concept, which is profit sharing. So at that point in time, they used to share a lot of their profits with their employees. So obviously the employees wanted to do really well because the incentives were very properly aligned, right? If the company does well, I get my bonus, I do really well. So very well incentives aligned, right? Then we come to the 2000s when or the late 1900s and the early 2000s, when the company starts facing very, very fierce competition. Walmart is there and some of the major retail giants that we know of today, they start cropping up. And in the early 2000s, Sears is really not doing so well. That is when our genius Eddie Lampert came in. He was really a guy who had made a mark in the financial world by investing into a lot of very, very, or turning around companies and investing in all the right ways, made a lot of money through those hedge fund investments. So in early 2000, around 2003, he bought another major retailer that was struggling called Kmart. Next year, he saw Sears was also struggling, thought it was a good deal. He bought Sears and then merged Kmart and Sears together to form one company. The idea was that you take two struggling companies, merge them together, and use economies of scale and so on to sort of get the best out of both, right? So you must have heard about synergies, right? Whether they are revenue synergies or cost synergies. So he really wanted to use that. And in those times, this was not a new concept because we know JP Morgan was really, really famous for doing this, right? He bought a lot of steel companies, merged them together, and then exploited economies of scale to really grow those businesses and was very, very successful in that. So Eddie Lampert, darling of the financial world, buying Kmart and buying Sears and then merging them. So it looked really rosy at that point in time. Fast track to today. Sears went into bankruptcy just before COVID hit, a few years before COVID hit. They have come out of bankruptcy. There is one spoiler here, which actually I will keep it as a suspense and share that at the end as to who bought the bankrupt Sears company. All right. So that is one tidbit that I'll share with you at the end of the presentation. And I'm sure it will come as a big surprise. All right. So going to the next slide. Yes, I mean, it's a very, so to Kush's point of big giants doing that, I mean, it's a very proven and old concept, because obviously if you have a good product does not mean you can build a good company. So a lot of companies have done this historically. Now, what I want to do is I want to just show you a few metrics, and a lot of these metrics, yes, you can Google it, but it will just spoil the fun because I'm building a story. But if you like spoilers, please go ahead. What I want to do now is some of the metrics that we were discussing earlier. I just want to show some of those metrics and how they were evolving over time, right? And already when you see these, right, you will be like, come on, any analyst would have forecasted that this is what is going to happen. But trust me, it doesn't happen. It's not so easy, right? So this is where the company was. This is after the merger with Kmart. And then 1 year of revenue growth. Do you want me to zoom the slides further?
Yes, Sambhav, you can just zoom in it a little.
I don't know if I can do that. Is that better?
No. Now we cannot see the content.
No?
No. You can reduce the size. You can, yeah, this is better.
I'm actually, I'm at 100% now.
Yeah, this is better.
Okay, great. So the revenues were going down. So now as an analyst, I do not make any hypothesis right now. Right now, I'm only making observations, okay? And for you, I have really laid out the operations in plain sight. But when you look at the financials, they're not as clear or as clean and crisp, right? So that is another work that you as an analyst would have to do. If you look at the interest expenses, right, they've been sort of consistent until about 2015 when they really started ballooning, going crazy, right? And we'll see all of these things, right? So a lot of these metrics, I think some guys already mentioned. So, and we'll look at some of those further, right? So cash on the balance sheet. This is what the cash was in 2007, and then it went down, and then it was a downward trajectory. Some years were positive, some years negative, and then positive again. Just like 2015 onwards, really terrible performance, right? Total common equity or total shareholders equity, right? Shareholders equity has gone negative. How is that possible? Anybody knows? Anybody wants to say that on the chat? How shareholders equity can go negative? No, this is not bankruptcy. Okay, so some of you got it exactly right. So I don't know how familiar you are with accounting, right? What happens is every year my profit after tax or loss from the P&L or income statement is transferred, where it is transferred to the balance sheet on the shareholders equity in a line called retained earnings. So if I have sustained losses for a long period of time, it is possible that on a net basis, my shareholders equity goes negative. Yeah. It could also happen, or it also means that my assets are lower than my liabilities, right? So my long-term debt it is super high. This is probably as a reason of the merger, right? And then they have paid down debt. But as you can expect from the previous slide where the interest expense was ballooning, right? Here, the interest expenses are going up. That means probably that the debt is going up, right? So just to elaborate on negative shareholders' equity, losses from profit or losses from the P&L flow into shareholders' equity every year. So if you keep having a lot of losses, which means the negative value keeps flowing in, that is, Pooja, actually, that is also a right reason. I have seen very, very good companies have negative shareholders equity. Why? Because they have been paying so much dividends, right? So that is also possible. That's a very solid point. So exactly, that's the whole point that I was making, that just looking at 1 or 2 or 3 or 5 metrics, we cannot know the whole picture, right? Just because shareholders equity is going down does not mean I jump to a hypothesis that everything is bad, right? It could be good as well. There are some very, very good companies that you can find which have negative shareholders equity only because they pay so much in dividends. So what flows into your retained earnings in the equity is actually profit net of any dividends that you pay, right? So if you keep paying more dividends than the profit that you have generated, because profit is a P&L item and dividend is a cash item, so that is possible. And if you keep doing that, your equity could go negative as well, even though you have very healthy profits, right? So debt is increasing, but what is also happening is a good company that is growing very fast, which is a capital intensive in a capital intensive industry, also could have debt growing. But here, if you look at the ratio, right, total liabilities to total assets also in 2015, it crossed 100%. That means more liabilities than assets, which we can also see in the previous one. To 2015 is when the equity went negative, right? So trends are all moving that way. If it is a negative trend, if it is a positive trend, it is going down. So yeah. So what about that? Now coming to their cash, right? Cash from operations started going negative in 2012. If you remember, what is cash from operations? It is your profit essentially from the P&L, adjusting for any non-cash items such as depreciation and other items. Also adjusting for working capital. Then you get your cash from operations. So cash from operations has gone negative, which is also okay. Maybe for a few years, maybe the company is restructuring, changing things, buying a lot of working capital. You don't know what it is, but it is another data point in a list of growing data points, right? Then if you look at CapEx, now CapEx is reducing over time. That means their expenditure on capital assets such as stores, right? Opening stores or maintaining stores is reducing with time. Now, again, you could argue that if my CapEx is going down, then that could mean that I'm not investing in the future, so my revenues will go down in the future. Yes, it could mean that, but it could also mean that I'm not a asset heavy business anymore. For example, the hotel example that I was giving in the beginning, which is where a lot of the hotel businesses were moving from an asset heavy to an asset light model, which means selling a lot of their assets to go completely on a lease or a franchise model, right? So CapEx is reducing. That could be positive or negative, but it is another data point in a list of growing data points, right? All right. And then we'll look at some industry specific metrics. So total stores, right? This was, of course, after the merger. The stores remain broadly similar at 4,000 level. And then in 2003, they closed down a lot of stores. And then since then, they've been rationalizing stores going down, right? And looking at same store sales growth, right? So this is someone mentioned this, right? This, I think, is the most telling metric in one go. Again, I would emphasize no one metric is the end all be all of financial analysis. It's a list of it's a multivariate analysis essentially. But this is one of the most interesting and important metrics that personally I would look at to see how a retail store company is doing, which is same store sales growth. What does it mean? It means, for example, I have 10 stores in year one. In year two, I have 10 stores. So out of those 10 stores, if I sold 100 rupees, that is my revenue. In next year, if I have 102 rupees of revenue from the same 10 stores, then that means that my revenue from same store increased by 2%. Now imagine if I added 2 stores, it became 12 in this year, but I reduced one store or closed down one store, then it became 11 stores, right? So from 10, I added 2, but reduced 1. Net, I'm on 11 stores next year. But now I only compare 9 to 9 because out of these 11 stores, 2 stores are new and 1 store I have closed. So I cannot look at those, right? So I look at only the comparable stores, which is 9 here, 9 here. And then I look at the sales in those stores across years. And then I figure out if my sales are the same or are they increasing or are they decreasing. So this is one of the most important metrics that people look at in the retail industry, right? Okay. Then the third point here is the Altman Z-score. This is a very interesting metric that this guy came up with for, and this is a very old metric for essentially capital intensive businesses where, according to him, good businesses, healthy businesses have a Z-score of higher than 3. 3 to 1.8 is 3 to 1.8 is sort of getting more and more into danger zone. 1.8 is scary. And then anything below that, at least earlier, used to mean that the company is headed towards bankruptcy. I think now those benchmarks and standards have changed because business models have changed. So the numbers might not be the same. I think they're closer to 0 now. But yeah, essentially, directionally speaking, you can see the Z-score is getting worse, especially after if you see from this point, right, from 2011, or in other way, if you want to look at it, it has been actually deteriorating every year from 2008, right? Okay. But can we compare sales of new store with the sales of previous store? No. So let me break down growth for you for a retail company, right? So how do I do it? I look at my 9 common stores, 9 to 9, that is same store sales growth. Then the sales that I get from the 2 new stores, I will add that as a new store addition sales growth. And then sales that I lost from the closing down of one store. For example, this store was doing 10 rupees in sales in first year, and then I closed that store next year. So I lost that 10 rupees. So that is the negative growth or degrowth that is happening, right? So an addition of all these 3 will give me my total organic growth in retail. No. So Altman Z-score is quite an old benchmark that was used in capital intensive industries, and the benchmark is very different. And I would, as an analyst, I would always tell you to be very cautious on templates and standardized rules because nothing of the sort exists anywhere, especially in finance, right? Everything is relative and you need to judge the pros and cons. That is why I started my presentation with saying, just because revenues are going down or capex is going down does not mean it's always bad. It could be some other reasons that you need to analyze and come up with, right? Can you give example for capital intensive? I don't understand your question, but capital intensive industries are any industries which require a lot of capex or capital expenditure upfront. It could be something like a industry, like a steel plant. It could be the hotel business. If you, infrastructure. It could even be telecom, right? Telecom, you pay a lot upfront for the auction process. Exactly. See, some very interesting questions. So Pooja is asking if 2008 that impacted. Yes. So then now, if you look at it from that context, right? And Pooja, that is a very, very good suggestion, right? Right now, when you look at it, it looks so obvious, right? Ye to hona hi tha, I would have guessed it in one go, is what you would say. But think about the situation, right? 2008, the entire world is struggling. In such a case, if your company does not do well, you're okay because nobody is doing well, right? So a lot of the work of an equity research analyst is to remove the noise from the signal. What do I mean? When we are talking, right? There's a lot. How are we talking on the phone? We are getting essentially these electromagnetic waves which are coming to our phones, right? And then as they come to our phones, also while they are being transmitted from the towers or the satellites, there is possibility of interference from a lot of noise sources, right? So similarly, in this industry, we get a lot of noise, lot of confusing data points, some data points which will point you one way, other data points which will completely point the other way, right? So a lot of the work of an equity research analyst is to strip down those noises and then figure out what the signal is within that noise. Okay. And it is not as easy as it sounds. It is not something that can be taught to you in a class. It is something that you acquire over a lot of years of work and experience. And it is very, very, and that is why in finance you get paid well, because once, so see, you need to know the tools. Once you know how to use the tools, the usage of those tools is up to you. And that is why anybody ever can teach you tools, but you have to figure out where to look, how to use those tools. Should I use a hammer? Should I use a screwdriver? All of that is up to you, right? All right. So what are some key takeaways from the above? So as we saw, revenues are declining, interest payments are increasing. That was driven by increasing debt, but not just increasing debt, but increasing debt to asset ratio. So of course, for a growing company, you would expect debt to increase on an absolute basis. That is, the total amount of debt will keep increasing. But if the ratio of that debt is increasing, then you would wonder, why is that happening? So revenues are going down, interest is going up, cash is negative, shareholders' equity is going negative because from the P&L, my profit after tax or loss from the P&L minus any dividends will flow into my shareholders' equity as part of retained earnings. And if it keeps going that way, negative for a lot of years, then on a net basis, my shareholders' equity can go negative, right? So we saw all of those. Lower capex. Why is there lower capex, right? Very, very important to figure out why there is lower capex. Store closures from 4,000 to 2,500, kept on rationalizing or reducing stores. A lot of companies, in fact, every company that you will ever read about that has a store presence will always, every few years, 3 to 5 years, they will tell you that they're rationalizing their stores. So then in such a scenario, you need to look at all of these different metrics to figure out this is not a natural or regular exercise. There is something wrong here. Some of the metrics that we discussed, right? Same store sales growth. I think that is a that is the canary in the coal mine, right? To figure out if the company is doing well or not. And then we saw Altman Z-score, which kept going negative, right? So these metrics are not always negative as we discussed, but all of them happening together, something to study, right? So let's go forward. Again, I will not say what is a good or a bad Altman Z-score. although the earlier benchmarks used to be 3 for a good score or greater than 3, and then 1.8 and lower used to be bad. But really now the business models are so different, so evolved, that I would more look at it as a directional element rather than looking at it from an absolute basis. Because in finance, there's nothing that is absolute. You can never say, if, as I gave you the example, capex is going down, then that is bad, or my cash is going up, then that is good. My working capital is going up, that is bad or good. There's no such one line answer ever in finance. So even for your interviews, when you sit for them, never say answer A is more right or answer B is worse. Never give that answer, right? You have to judge the pros and cons of each scenario. So that is something that I always discuss in my classes. Anyway, so we are just looking at the sales and the locations of all the biggest retail companies in the US over time, right? 1990, 2000, 2010, and 2018. So you can see the sales for Sears and Kmart in 1990, right? And this is in millions. So 32 billion, same as Walmart at 32 billion, right? And then the Sears that we know is the sum of Sears and Kmart, a merger of these two companies. No, working capital is very, very different from shareholders' equity. It's completely different. There is absolutely no commonalities between the two. Now, going forward, 10 years forward, their sales are broadly in the same range. Maybe they've increased by inflation or maybe not. But meanwhile, Walmart has grown 6 times its size versus previous 10 years, right? Home Depot, almost, I don't know, growing so fast, right? Target, Lowe's, Best Buy, all of them growing and really giving Sears and Kmart together a competition, which is why we saw them struggle. Then both of them merged. And then now in 2018, their revenues were not even half of what they had combined in 1990, right? So crazy numbers. And then if you look at the locations, about 5,000 stores, both of them put together, to less than 1,000 stores. Now, in fact, not even 20 stores, right? All right. Let's look at the share price. Someone said you would track the share price. Yes, you should always track a share price of a company that you're tracking or analyzing. So share price went up, and then 2005, this is because this guy, Eddie Lampert, who features again, was buying the company, trying to turn around the company, and then continued bad performance. You remember 2008, of course, was a tough time. And then after 2005, it was really just going to worthless. Yep, let's go forward. So 5 reasons the company went from the biggest retailer to a bankrupt organization. All right. So, I mean, I can give you a lot of examples of really visionary, really innovative companies that in our lifetimes have gone from being the leaders in the market to nothing, right? Let me give you a few very common examples. Kodak, right? Or Nokia phones, or BlackBerry for that matter. A lot of these companies, Yahoo, that's the most amazing example, right? Yahoo at one point was supposed to buy Google. I think that was for what, $5 or $7 billion, something like that. That was obviously a long MySpace, of course. A lot of these internet companies, but also infrastructure companies and product companies. So just because you were innovative in the past does not mean that you will all stay around for always or forever. So you always need to keep innovating. It's just like the human body. If you're not growing, then you're receding, just like your muscles. All right. So Richard Sears, he was a visionary. We discussed this. So he used railway infrastructure. He calculated the introduction of cars. So he started opening stores in the 1920s. And then, okay, so coming to some of the extracurricular activities that the company was doing, right? So the Discover credit card that a lot of you might know about, it's a network operator like Visa and MasterCard. So that was actually started by Sears. They also had a financial services company, Dean Witter, which later on merged with another financial giant. So they kept, they even had a real estate company that they hived off. So a lot of these assets that they kept building up and then hiving off. So in 2005, when Eddie Lampert bought the company and merged it with Kmart, right? A lot of these sales, he was actually either doing to other companies, and of course, he was benefiting because he was selling those and he was the owner of the company, right? But a few of these companies, he also sold to his own owned entities, right? For example, at one point, Sears sold off, so they went asset light as well, and they sold off a lot of their main retail areas to another entity that was also owned by Eddie Lampert. So bit fishy there, related party transaction as we would call it. But yeah, so those kind of things kept happening. Let us go ahead. Inability to stay ahead of competitive threats. Now, if you look at Sears, right? So they were facing competition from Walmart and then eventually from Amazon as well, right? So from Walmart, if you notice, right? Walmart, Target, those are your really discount retailers, which Sears failed to become eventually. They were able to have huge stores outside the city and provide just everyday items at very, very low costs. Because of which, of course, like if I want to buy a lot of stuff, I would rather go to Walmart, because this is also early 1900s. People have a lot of time, unlike today. So where everything we want immediately, right? So we have Instamart and Blinkit and whatnot. But back then, people had a lot of time, so they would prefer to go outside the city and buy from a Walmart or a Target. Meanwhile, there was this online play happening as well. So Amazon and everything was also taking off. And Sears, although they also started their online business, but they could never, win either of those, neither the retail nor the online business, essentially. There's one very interesting pie chart here. So in 42 quarters, they only had 1 quarter of positive same-store sales, right? Growth. Otherwise, in 41 quarters, it was negative. I think that is an insane predictor of what is going to happen in the future, I think. Okay, lack of focus and a bad acquisition, right? So it could be lack of focus in terms of products, but if you think about it, Walmart, Amazon, they all do something like that, right? All the major big Home Depot, all those retailers also sold like a bunch of different things. But also we have very, very specified stores as well that will only store one product, like a bag store or a shoe store. So we have companies that have succeeded in both, right? But I think in terms of Sears, right, the lack of focus was in terms of their business model. While they're doing retail sales, they're also dabbling in financial services and this and that. And this is something that you will notice a pattern of, right? All the major conglomerates. Now, conglomerates are a very, very interesting beast in and of themselves. In the Western world, right? Everybody hates conglomerates, and instantly, when you do a valuation exercise as an equity research analyst or as an investor, right? You give a valuation discount or you reduce the valuation of a conglomerate because of the risks of being a conglomerate, of focusing or taking that. With one risky bet, you can take down the entire house of cards, right? Which is Not so much the case in Asia, in my opinion, because in Asia, we have a lot of, whether it is India or even areas like Korea, right? Korea is very popular for, I know we know all about India, so I don't want to talk about India, whether it is Reliance or Tata and all of those, because Reliance virtually owns 40-50% of the entire retail space in India, right? Whether it is apparel or food items or electronics, whatever it is, right? Uh, Coming back to Korea, Samsung is a great example of, we know them for phones, but they have so many wide businesses, right? So coming back to the point is, in the West, yes, exactly. In the Western world, um, focus is very, very, the Western world has found that a lot of conglomerates have struggled as they've grown bigger. One huge example is GE, which grew very fast, became a conglomerate, and now over the last two CEOs have been trying to, rationalize the business and reduce and so on. So a lot of lack of focus, definitely one of the reasons why this happened. No investment, right? So we saw capex going down, and if you look at how much they were spending on a per square foot basis, now again in the retail world, very important metric is looking at what are your sales or profits or investments on a per square foot basis, right? So if you look at how much they're spending versus how much a Walmart is spending, it's incredible. And if you look at some metrics here, right? So how much Best Buy is spending $15 per square foot versus them spending not even $1 per square foot, right? We discussed this, right? So Eddie Lampert had a habit of selling Sears real estate assets for cash, and all the other businesses as well. Can you not see the screen? How do you consider or rate Tata? Tata is a whole another beast, and I think analysis of that would take months. So I will not go into that for now. But please let me know if you can see my screen or not.
Sambhav, I can see your screen.
Okay, great. I think Abhishek.
Maybe you can stop sharing once and reshare it.
All right, I'll do that. Okay, visible?
Yeah.
All right, great. So this is where we were. And then too many missed opportunities. Once again, I will just put this down. Open chat. Yes, okay, great. So they missed growing on the retail side from the Walmart to the Walmart kind of businesses, Target, Best Buy, you name it, Home Depot. On the online side, they missed the online bus. And now, I mean, they've really, from 4,000 stores, they were down to like a few hundred, and now so they went into bankruptcy in 2018. And I think they came out of bankruptcy like last year, and they were bought by a group. And I think today total Kmart and Sears stores are like around 20, but since it's a private company, we don't have a lot of information for them anyway. Right? So how does spend on per square feet basis affect them, right? So I think that is a very genuine question, Priyanka. Thank you for that. Just a simple example, right? Would you want to go to a Zara store if it was shabbily kept, if the racks were broken, if the if the cash register never worked, if things were just in a bad state or there was no cleaning, right? You would not want to go. So what happens is the amount of investment that companies do in their store is to make sure that especially in a place like a retail store, which requires a physical presence, right? It is all done so that customers, when they visit your store, you feel good. So you can give a lot of examples of companies that have worked a lot to make sure that just the aesthetic is so good and pleasing that you want to go there, right? Why do companies or stores or cafes play music? Why is it so pretty? Why is it painted and decorated? All of that, right? So that is how spend it impacts your footfall as well. And also just the efficiency, right? If I buy something and I have to get into line because two other registers are broken, cash registers are broken, and there's only one that's working, so that's really bad for me as a customer experience point of view. So spend actually directly impacts customer experience. A lot of people think business metrics are very different from finance, especially people who are on the business side of things. They think finance ekdam alag hota hai, finance is very different, business is very different, no links. But as someone who's been on both sides, right, I can directly tell you every business decision has a financial impact and vice versa. Every financial decision has a business impact. Right? Yeah, I mean, will it work if cost per item is high as compared to competition? Are you seriously telling me that people don't go to Starbucks because it is too expensive compared to the neighborhood cafe where you can get the same coffee for half the price? Or, I mean, so many examples, right? Apple phones, you cannot objectively say all Apple phones are better than all Android phones. So yeah, it's all about the niche that you're able to create for yourself. For same item, yes, but also in retail, right? Sometimes you have commodities that you're selling, but at other times you have brands that you're selling. And it could be that you have exclusivity on brands and so on, right? So of course, I will never say that it is only a one metric problem, but it is a combination of metrics. So that's what I've been forcing. One of which is how much you're investing in the stores to make sure that they are outfitted in the right technology, they are pleasing to visit and so on, right? So I hope that is clear. Yeah. Okay. So now coming for the spoiler, right? So what happened with the bankruptcy? Once again. And this is very interesting. So bankruptcy judge approved the sale of company's asset to, surprise, surprise, Eddie Lampert. So the guy who owned the business, who was running the business on the equity side, also, by the way, who gave a lot of debt to the company as well. So he was on both sides of the balance sheet, right? He owned the equity, he owned the debt. His company was going down. He was not able to pay his own debt. So from one pocket to the other. So he filed bankruptcy and eventually he bought his own company. So it's very interesting. Now he's closed the whole company. It's turned into a new company called Transformco. It has, I think, 20, 40 stores. And yeah, it's hilarious. But I don't know if, and it could be a very interesting exercise, but we might never know very surely if Eddie Lampert made a killing out of it, right? Because you can do this. You can take a huge business and keep hiving off assets out of it and make a killing while simultaneously giving your business a slow death, right? So I don't know. I am not insinuating one way or the other. Owners don't always make a killing. I will disagree there. In fact, most owners lose money. Most owners and most entrepreneurs lose money. Is Lambert an investor in Walmart? I wouldn't know that. Maybe we can check. If only if he's a significant shareholder can we know. But yeah, in fact, entrepreneurs who start businesses take the biggest risks, and that is why they are provided with the biggest reward as well. So that brings us to the end of this session. I would just like to share one more screen with you, which is just to show the different businesses that this guy used to have. Let me just share my screen. Right. Can you see my screen?
Yeah.
Yeah. So this is just a few examples of companies. So Land's End, Dean Witter, which was a financial services company, Discover, which merged with Morgan Stanley, as I was saying. So a lot of business, and this is a few, right? Lot of businesses that they started, that they sold off and made a killing. But eventually, in the long run, they stopped being an innovative company. They stopped sharing profits. They stopped incentivizing employees. They stopped coming up with new products to keep customers engaged, and that's why they lost. Just like in a good market, if you stop being a good company, you lose out. So yeah.
Thank you so much, Sambhav, for this lovely session. And I hope this was really an interactive session for our audience as well. I could see the chat box. It's full of questions, queries, exciting interactions. And I hope this was a insightful yet exciting session for them as well. Thank you so much for being on board for this webinar and sharing this topic with us.